With just days to go for the Union Budget, stock market expectations are mostly grounded. Markets are not pricing in dramatic announcements, but are preparing for stability, discipline, and selective spending. With major tax reforms already introduced last year, analysts say Budget 2026 is expected to be more about consolidation than surprises. So, what are brokerages really watching this time? For FY27, analysts broadly expect the government to stay the course on fiscal consolidation. The focus is likely to remain on controlling the fiscal deficit, managing government debt, avoiding populist giveaways. Most estimates peg the fiscal deficit target at around 4.2% of GDP, slightly lower than FY26. Instead of chasing short-term growth through heavy spending, the government appears keen to protect macro stability, and that's something markets usually like. Brokerages are unanimous on one thing: capital expenditure will not be cut. But they also expect a change in composition. Instead of broad-based infrastructure expansion, spending is likely to be channeled into strategic and high-impact areas. Most estimates peg FY27 capex at around 12.4 to 12.5 trillion rupees, roughly 3.1 to 3.2% of GDP. Nomura expects macro stability to remain the government's top priority. It believes Budget 2026 will rely more on reforms and regulatory fine-tuning rather than fiscal expansion. Possible focus areas include expansion or redesign of PLI schemes, support for MSMEs and exporters, higher defense allocations, customs duty rationalization, and strengthening critical mineral supply chains. Morgan Stanley expects Budget 2026 to remain firmly capex-driven. It sees 12 to 15% growth in defense capex, 8 to 10% growth in core infrastructure spending. The brokerage says markets will closely track fiscal consolidation, capital market reforms, and measures to revive foreign portfolio inflows. And what are domestic brokerages expecting? ICICI Securities expects Budget 2026 to limit overall spending growth while prioritizing development-focused sectors. It sees strong policy support for manufacturing, infrastructure, and PLI-linked industries. Motilal Oswal expects the budget to be framed around a nominal GDP growth assumption of about 10%. It forecasts capex at around 12.4 trillion rupees, fiscal deficit near 4.3% of GDP, and higher gross borrowing compared to FY26. The brokerage also flags continued pressure on bond yields due to supply-demand imbalances. So brokerages broadly agree on sector-level expectations. Positive bias towards defense, infrastructure-linked manufacturing, MSMEs, and select consumer segments, especially if consumption support continues. Then there is a cautious outlook on autos with limited policy triggers expected, and oil marketing companies due to possible fuel tax changes. If you found this breakdown helpful, stay tuned for more such budget explainers and analysis.